Three professors will present their papers on financial education in the specific areas of insurance, payment cards, and mortgages. Our first paper presenter is Professor Sojung Park from Seoul National University. Her paper will be about the financial literacy and the choice of insurance products. Professor Park, it is a pleasure to have you with us. The floor is yours.
Okay, thank you. Let me share my screen. Okay. All right, can you see my screen and my voice? Okay, I'll go ahead. Okay, thank you very much for giving me this opportunity to present my paper. This is very preliminary study, so a lot of suggestions would be great, very beneficial for my improvement for this research, I think. When and how I got started with this project has a lot to do with this meeting, actually. So a few months ago, maybe you remember Professor Cho and Ms. He and Professor Choi and me had this, lunch meeting at Chinese restaurant, right, to discuss about our this meeting in the summer. And Professor Cho just introduced me this database about financial well-being that I have never aware of, and I thought that was a very interesting database. And also, actually, frankly speaking, I am, this financial education and financial literacy was not really my research area. So I'm doing insurance research, but not really into this, education and etc. But anyway, because of this meeting and thanks to the database, I thought, oh, this is a very interesting area and probably worth to take a look at. And by that time, actually, one of my students was looking for his topic for master thesis, and I gave him this database. Hey, go and take a look at this database. There's two very interesting variables in this database. One is, do you have life insurance? And the other is, do you have a health insurance? And the rest of other, like hundreds of other variables about individual characteristics and other, financial literacy, financial well-being related variables. So basically, we got started this project just a few months ago, and we have a little bit of a result. So I want to share that result with you today. So originally, I was thinking to do some research about financial well-being, but before doing that, there was a little bit of a problem issue with that. I will share that with that issue with you later on. So we will start with very simple but very old topic of this insurance demand, basically who buy insurance. So about who buy more insurance, there is very lengthy literature on this topic, mostly based on these theory models, notably Yari's paper and Lewis's paper. Basically, they have this life cycle model, and they show who buy how much insurance, why, to maximize their expected utility. And from these models, of course, we can tell if you are risk averse, if you have more money, and also if you expect a higher inflation, maybe less insurance, and also if you have more dependents and have a higher bequest motive. I mean, these things altogether affect the demand for life insurance. So following empirical studies, lots of empirical studies try to test whether this is really the case or not. So there are two sets of studies testing the life insurance demand. One is testing this international studies, so testing this life insurance demand using this global database. So in which country do people buy more insurance? So those kind of data. And the other is this using individual panel data. So specifically who buy those insurance and how much type of studies are there. But most of these studies actually are based on this very neoclassical theory, people try to maximize their expected utility, and they don't really talk that much about financial literacy or education aspect of that. And also they don't really talk about that behavior finance or behavior economics stories either. They kind of assume that, you know, people are rational, and then like who buys more insurance, that's like mostly their focus. And but I think recently I have become really interested in this behavior economics story, and those, you know, life cycle model may be reasonable, but maybe that's not the case when we talk about these individual policyholders, like financial consumers. And by looking at this paper, I was thinking maybe I can test something about the relationship between financial literacy and the demand for insurance. And I looked up for a paper, and I found out this recent paper published in Pacific Basin Financial Journal. And they did look at the relationship between life insurance demand and financial literacy already. And they used other database, and they found there exists some positive relationship between financial literacy and financial consultation, and that, you know, demand of life insurance basically means, okay, if you understand better about the financial, you know, stuff, then you buy more life insurance. That was their conclusion. And also, there was even before this study, there was a bunch of other papers who looked at the relationship between general education, not really financial education per se, general education, and the demand for life insurance like this. So there are, like, you know, from 60s, there are so many papers using testing these hypotheses. Their topic is not really education. Generally, what relates with the insurance demand, that was their you know, testing hypothesis. And in most studies, actually, education they interpret education as a proxy for risk aversion. For example, like if you are better educated, maybe you are aware of the risk better, and people tend to be more risk averse. Therefore, the insurance demand should be higher, kind of story. But as you can see in many papers, depending on their specification and data, actually the result is a little different. In some studies, they find a positive relationship between education and insurance demand, and some other studies, they do find like a negative relationship between education and the demand of life insurance. So so now more details on my study. So what is missing, I thought, is in addition to this previous literature, I was thinking, is more the better. So we talk so much about, you know, this mis-selling, you know, brand kind of thing, and people are so unhappy with their life insurance. They just kind of, you know, buy this life insurance, but they thought this is not necessary, and later on, for some reason, they cancel it out, and they became really angry, kind of story. So simply buying insurance, is it really people making an adequate, the right choice for the life insurance? That was my starting point of this study. And I searched for the adequacy of life insurance. So all of those previous literature, basically, they kind of assume that buying more insurance is the better, and who buys more insurance? Like, you know, better education, people buy more insurance, higher financial literacy, people buy more insurance, but they kind of assume that, you know, more is better. And assuming there's a huge gap between this, you know, life insurance coverage and the risk itself. Maybe that's the case, but I was thinking maybe that's not the case. And I found out this 2003 paper, AER paper, very well written, nice paper. They show the mismatch between life insurance holdings and financial vulnerabilities. Evidence from the health and retirement study. So what they do is they kind of try to estimate what is the financial vulnerabilities. So if this person dies, how much you lose their dependent will suffer. So what is the real size of the risk regarding life insurance? That's what they do in one hand, and they match that financial vulnerability with life insurance holdings. So that's what they do, and they, as the title says, what they find is there's a huge mismatch. So some people buy life insurance and some people don't, but there's a huge mismatch that, financial vulnerability and actual demand for life insurance that has almost no relationship. So some people buy insurance, but that doesn't necessarily mean I'm more vulnerable, therefore I am exposed to higher risk. So I kind of buy more insurance. That didn't really happen in this life insurance world. So I couldn't find many other following up paper after this paper, but it was kind of interesting. And their main finding is there's a significant mismatch between financial vulnerability and life insurance holdings. And some recent studies also shows some behavior aspects regarding insurance demand in general. And for example, this study, a QJE study, shows many people chose very bad policy, dominated low deductible policy for their health insurance plan, but this could be corrected when the policy was better explained. So some of nudging, or it kind of shows that people are really that rational and know everything when they make insurance related decisions. And this Gottlieb Olio Mitchell paper, Jerry 2009, says, okay, the demand for long-term care insurance is very low in the United States, and one of the reasons is these behavior issues. People have kind of a narrow framing, a bias that tend to purchase less insurance, less long-term care insurance concerning for other factors. So apparently these evidences show there is mismatch between insurance and the real risk, and also there is some behavior biases. People are not that smart enough to make their optimal policy. So building on these things, I put together my hypothesis here. So maybe I will find some positive relationship between financial literacy and life insurance demand in general for many reasons. Probably know better, so you think about it better. So maybe like the previous paper, maybe I will also find some positive relationship between financial literacy and life insurance demand. And this database that I have these variables like subjective knowledge and also objective knowledge. So subjective knowledge is, do you feel like you know a lot about finance kind of stuff? That's like subjective knowledge. And objective knowledge is actually testing with some finance questions, and whether you have answered that question correctly. So that measures your objective knowledge in finance. I have these variables, and also I have some other interesting variable about financial socialization. It doesn't necessarily be your own knowledge, but you have some people around you who can give you some advice. So you talk about these things with some people, next to you, and your parents educated you about these things, kind of things. So those are related with this. Those questions are related with the financial socialization. So first of all, I think maybe I have possible relationship between these things and life insurance demand. And there's another interesting variable about this life insurance demand, which is propensity to plan. So is this person a person who tend to plan for everything and also think ahead of time, kind of variable? So I think that variable should have a positive relationship between with life insurance demand, which is kind of a long-term demand, long-term lifetime decision making. And in addition to that, this is kind of not that interesting already. Some other people have done that, but in addition to that, I have another variable, which is, the question is like, do you have a dependent children that you need to support financially? If the answer is yes, it means this person have demand for life insurance. This person is exposed to the risk of dying early, right? So there is a variable about the do you have dependent children. So apparently, if we are making an optimal decision, if you have dependent children, have to buy life insurance. Otherwise, actually, whatever education, whatever, you don't have demand. You don't need to have life insurance because you are not exposed to any risk, right? So I think this variable should have very strong relationship between with the life insurance demand. And the third one, this was actually my most important variable. So I interacted this behavior story, financial literacy and propensity to plan kind of behavior story, with this advocacy variable. So if you're better educated and if you have better financial knowledge, and if you tend to plan things ahead, if you can really think of what what this is, do you buy more insurance when you have dependent children? So the third is the main, my new contribution to this literature, I have to say. So my question is, okay, do people with better financial knowledge and better financial socialization and propensity to plan, do they make a better insurance decision? And I'm gonna test that with this life insurance database demand. Okay, any questions? So this is going to be my main hypothesis to test. Okay, and the data, I assume many of you already know the data because we talked about this data in our Kakao talk several times. So it's really nice nice one. So if you I can this, if you click on this link, there is all this it leads to Consumer Financial Protection Bureau. It just share it gives all the data and the explanation and code for this data survey result, so anybody can utilize this database. It has a survey conducted in 2016 for US adults, and they have more than 6,000 survey results and questions about financial well-being and other related characteristics. And fortunately, they had this very simple survey question about life insurance and health insurance that I could use. So these are the list of variables that they have: individual characteristics, household characteristics, and etc. So I use these things as a control variable on top of those important variables that I have mentioned. So I run very simple logistic regression because the dependent variable is like of 0 or 1, have it or not. And these are the specifications. So I control for individual characteristics, the household characteristics, and insurance needs, which is measured as do you have dependent children, and financial literacy variables that I explained, propensity to plan. This is the very simple initial regression that I run, and in addition to that, I run the main regression with these interaction variables that I have explained. So, and this is the very brief result that I'm going to share. So I have a slightly less observation than the full sample because there are some missing variables. So after getting rid of those things, I have a slightly more than 5,000 variables here. And life and non-life, if no life, about half of the sample people have life insurance, and about half they don't have life insurance. I think this is a kind of very nice setup because half has it, half don't. And also we have a financial well-being score, which we didn't really utilize at this point, so maybe I'll forget about this. And here, so if we simply compare these two groups with life insurance and no life insurance, in terms of subjective financial knowledge, life insurance holders, they tend to have higher life insurance, tend to have life insurance, and propensity to plan, yeah, definitely those people who buy insurance, they have a higher score on propensity to plan. Financial socialization higher with the life insurance buyers. Children that I support financially also very different. As you can see, this is really the measure for life insurance demand, and looks like people are really making the right decision. People who have children to support, they do buy life insurance. And homeownership is another actually very important variable that I haven't really mentioned. A lot of people probably have to first to buy homeowners insurance to take like mortgage loans, like to make sure they, even if they die, they the banks they make sure they can have their money back, kind of story. And another very interesting variable was non-retirement investment. I thought it could have two-sided hypotheses regarding this variable. If you have stocks and bond investment, it means it's kind of another important variable for financial knowledge. You know something about these investment vehicles that are out there, so your financial knowledge could be pretty high. And also, if you are stock investors or bond investor or mutual fund investor, you probably are less risk averse. So I thought it could kind of measure various things. Anyway, it had a very strong relationship with life insurance demand. And this is our main regression result. We control for age, household income, education, and also we have a bunch of other controls, marital status, and pretty much all important race and things like that. We controlled for all of those, and even after controlling for these, like education and etc., on top of these things, having better financial education did have some positive relationship with life insurance. So this is the variable for objective financial knowledge. Those people who know better about financial stuff had higher, they bought more life insurance. And financial socialization, propensity to plan, subjective financial knowledge, they all had a positive relationship as expected. And children that I support financially actually had a very strong relationship with the life insurance demand. The same is true with the home ownership, actually was stronger. And non-retirement investment also had a very positive, strong positive relationship with life insurance demand. And the second, for somehow I was interested in this, the same set of relationship in poor groups and wealthy groups. Maybe all of those variables possibly have different relationship in these poor groups and these wealthy groups. Although I do control for this household income, I thought could be very systematically different relationship could be possible. So I ran the same regression in separately for these two groups, and in this poor household, financial knowledge and financial socialization is important. Propensity to plan, subjective knowledge, children that I support was not quite important. It was actually the home ownership that was very, very important, dominantly important. If you have a house, you have the life insurance demand instead of children that I support financially. It was kind of interesting result. So probably I want to dig into this thing further. Anyway, for the rich groups, the result actually was exactly the same as before. And more interesting, now finally I have this included this interaction term with this financial, the behavior variables. So I have added this knowledge and children to support, propensity to plan, and financial socialization. So all these things are included now. So as you can see, these interaction terms were quite important as expected. So when you have better financial knowledge, children to support had extra positive effect So those people who have better financial knowledge, when they have children to support, they buy life insurance. And financial socialization, actually it became it was not significant for in this case, but propensity to plan and subjective knowledge and home ownership subjective knowledge, these things also has become looks like it was important factor. And I thought this was very interesting in this case. For this is the regression for poor group, and this is for rich group. And for the poor group, actually, this interaction effect kind of dies out. Here it dies, and here it dies. Actually, the financial knowledge is important, and home ownership is important. But then here, this financial socialization actually have negative sign. So when you have people around, actually it kind of gives you wrong advice kind of thing. Like, it's not like, those finance or socialization really doesn't really help you to, it helps, it makes you buy more insurance, but it makes you buy more insurance even when you don't have children to support. So financial socialization was kind of interesting variable. So probably I want to look into this variable a little bit further. And rich groups actually was kind of consistent with the previous, all these in the predictions. But here, I thought this kind of financial socialization was kind of a strange variable in certain groups that I have found. Okay, so next, so the main result was presented already. The next one is, we did a little bit of robustness check on indigeneity on KH measure. So these are the, questions this survey tests the knowledge, financial knowledge. And one of the question here is, do you know the difference between whole life insurance and term life insurance? So I thought those people have better knowledge, may buy more life insurance, but the opposite could be possible, because you are to buy insurance, you talked with this financial advisor and you kind of searched for these things. So because of the process of purchasing this insurance, you became more knowledgeable about, all these, financial knowledge, especially the difference between whole life insurance and term life insurance. So to check, kind of to get rid of that possibility of reverse causality, here you have generated one more KH score that we got rid of that life insurance related question, and we separated that out, life insurance question here. And also we ran regression without this variable. The results were basically the same. So the main results didn't really change. The size of coefficient and the t-stats mostly stayed quite stable about that variable. And I ran another kind of robustness check. So it's possible that life insurance is possibly provided by your employer, although we do control for whether you are employed or self-employed or not. I mean, those variables, we do control for that. So maybe some other factors affect this. So to check on that, to make sure this interaction term really is about life insurance, because we have this health insurance variable, we ran the same set of regression on health insurance. And as you can see, none of those interaction terms were important at all when it comes to the demand for health insurance. And of course, that is expected, the health insurance demand and children to support doesn't really have any relationship, and the result really shows that. So kind of show our previous result is kind of more reliable, I think. And discussions and future study, this is my last slide. So my original question was about the adequacy about life insurance. Do people buy the right amount of insurance and the right people, do right people buy insurance? Like, for example, my single friend who doesn't have any dependent, she asked me, should I buy life insurance? Because some agent came to me that told me that I have to buy life insurance immediately today because the interest rate will go down tomorrow. So I told her, no, you don't have any dependent. Forget about it. But looks like many people actually make decisions like that. And my question was, first question is, do people who need life insurance buy insurance? And the second question was, because this database was about financial well-being, when people buy the adequate, I mean, when those people who are exposed to the risk, when they buy that insurance, does that improve financial well-being? But, simply having life insurance doesn't really improve financial well-being, but the right amount of, or, the right demand for life insurance may enhance that financial well-being. I mean, those kind of were, that was my, I really was interested in that topic. But then I ran very brief regression here. The dependent variable is the financial well-being score. And the control variables here is pretty much the same. As you can see, there's no relationship between life insurance and the financial well-being. But in this setup of regressions, actually has very serious, I think, endogeneity or reverse causality issue, which means those people who have life insurance, probably they are better in many other senses, although we have controlled for many factors, but still maybe financially well-being, the people with a higher score, maybe they buy life insurance. Maybe the causality still flow the opposite way. So even if I find a very significantly positive result, or thinking maybe I still cannot trust that result. The causality, it's hard to believe, but I have not gave up. I still want to see whether the adequate level of life insurance can enhance the financial well-being, but unnecessarily purchased life insurance it does not improve that financial well-being. I still want to test those issues if possible. Somehow, if there is a way to get around with the endogeneity issue, I still want to explore that question in the future. Okay, that's all I have prepared, and thank you for listening. Okay.
Thank you, Professor Park, for your research about the level of financial education, literacy, attitude, and risk, those factors, and insurance demand. It was very interesting, and actually I have like some questions, but I'm a moderator, so I'm not really sure if I should ask you now. But just one glaring question is, you talk a lot about children, dependents, but I was wondering if the data has anything about spouses, husbands, wives, because it seems like you don't care about your wife or husband, but you care more about children or whatever.
Okay, they do have the question about like marital status, so whether we are married, single, or widowed. They do have that variable, so I did control for that. But unfortunately, it would be really nice if I have variable that the income of your your income and your partner's income, but that database does not have that income information separately, so I just have this marital status variable with the household income. That's all I had.
Thank you. Thank you. So our next paper presenter is Professor Gianni Nicolini, who is a professor in banking and finance, Faculty of Economics of the University of Rome, Italy. Professor Nicolini will present a paper about financial fraud on payment cards, the role of financial literacy and education. Mr. Nicolini, Professor Nicolini, it's a pleasure to have you with us. The floor is yours.
Hello, my name is Gianni Nicolini, and I'm an associate professor of finance at the University of Rome Tor Vergata in Rome, Italy. First of all, I want to thank you, the IAFICO organization, for the invitation, and say that I'm really glad to be here with you today. Today, I will talk about financial literacy, financial education, and payment cards. So credit cards, debit cards, and prepaid cards. And especially referring to financial frauds, so scams that involve somehow those kind of payment tools. Let me share my presentation. And okay. So the title of my presentation is Financial Fraud on Payment Cards, the Role of Financial Literacy and Financial Education. Let me start with some data from the industry. Why credit cards? Why payment cards? Payment cards is a growing market because in 2017 we had 2.1 billion cards in the US. We have 812 million cards, active cards in Europe, and 6.6 billion cards in China. But it's not just the size of the market, but is a growing trend that make this area quite interesting from an academic point of view. Because we can see how we have 200 million new cars in the US from 2017 to 2019, and we have more than 1 billion new cars in China in a single year from 2017 to 2018. Generally speaking, the percentage rate of this market growth are pretty high. But even the number of transactions is something that matters, because we can have many cards and use only a few times a month, or we can have a single card and use many times a day. The number of transactions in 2018 in the US was 131.2 billion. The same number in Europe was 69.2 billion, and we had 210.3 billion transactions in China in the same year. So we have a market that is quite exposed to frauds, because once you have so many cards and so many transactions, this is something quite interesting for fraudster. And data that are not available for China, but say that in the US we had $6.11 billion losses for frauds on credits and debit cards. The same number in euro was 1.8 billion euro. That with the current exchange rate is not so different. And the weight, the role, the relevance of this number is even more clear when we refer to the percentage for the total transaction. In the case of credit cards in the US, we have that 0.17% of the total value has been victimized in terms of be victim of a fraud, and this 0.17 is compared with 0.11 in the European Union. For debit cards, percentage are lower because we have 0.09% in the US, but compared with 0.02% in Europe, the big picture say that the number of fraud, but even the relevance of fraud for the market is much more severe in the US than Europe. If we refer to Europe, data from 2017 say that we had more than 30 million frauds on credit cards, and almost the same because we had 28.7 million frauds for debit cards. But what is really interesting, what is really somehow even shocking, is the growing trend, because in only 4 years we have an increase beyond 100% in the number of frauds in both debit and credit cards. Why financial frauds are so relevant? Can be explained by different point of view. A financial fraud is relevant for the user. The victim of the fraud will lose their money, so we have a money theft. But at the same time, there are other economic side effects, like the time and money needed to establish the identity and the credit standing, or the loss to of access to credit due to the deterioration of your credit score because you have been victim of a fraud. And there are even other non-economic, non-financial effects, like a psychological effect that can push you in a state of anxiety or depression. Of course, those effects are bigger when the amount of the loss are bigger. And it's not only referred to credit card, but are even more severe when we deal with investment fraud. The issuer is another victim because the issuer can be negatively affected for the loss of reputation and the negative effect on the brands. And it can even be financially affected for the cost of to deactivate scam site and reset password, as even the company stock price that can be affected. We can just refer to the case of some hackers that just stolen data for credit cards, and this is something that can make the stock price plummet in a single trading day. The seller is another possible victim of the fraud because he can lose money, but he has even to pay for the cost of fraud detecting technologies, and there are even the hidden costs related with the missing profit from denying suspicious but valid transaction. So it's all the market that is affected by this kind of fraud. If we had to summarize the motivation of the study, the first point was the relevance of payment card fraud for the payment card market. So it's something relevant for the market. It's something relevant for the user. So from a consumer point of view, it's a topic that negatively affects, for sure, a financial consumer. And we can go beyond the victim of the fraud and refer to the consequences for the entire system. So I think it's a quite interesting area to investigate, because there are so many possible effects that are not only related with a single user in for a single fraud. The aim of this study are three different aims. The first one is to identify how much people are able to identify and avoid the fraud. So what is snapshot about the current ability of consumer to avoid a fraud on payment cards. The second aim is to assess the effect on financial literacy on preventing victimization of financial fraud on payment cards. So are the most financial literate individual the one that are more able to detect the fraud or not? And the third point is try to test how much a single one-shot financial education event can improve the ability to identify financial fraud. So how much financial education can help in dealing with financial scam on cards. The literature is pretty big when we talk about financial fraud, but is quite focused on investment fraud. Shuttle and Peck find that investment fraud victims demonstrate a better understanding on basic financial literacy than non-victims. And so he suggests that financial literacy matter when we deal with financial fraud. Similar results has been found by Lokenanen in 2014 on data from tribunal cases from Canada. And you're right to say that those most vulnerable were investors who were retired and had limited investment knowledge. So less you know, more likely you are to be a victim of investment fraud. Similar results come from the US with Kiefer and Motola that in 2017 analyzed investment fraud. And what is interesting here is the last point, where higher level of financial literacy is associated with an increased probability of investment fraud victimization. So somehow they suggest, or a possible interpretation is that more you know, more you feel confident about your ability, that can turn into the victimization when you in the use of your payment card. But it's not only studies from the US, because we have even studies from Cyprus and studies on Ponzi scheme, so in different kind of fraud. Engels and all find that financial literacy is relevant in predicting the ability of individuals to detect financial fraud. And other studies, for example, studies from China, analyzing the role of financial education. And Gui, Wang, and Zhao in 2018 find that evaluation of a high-opening financial education program they find that participants have a significant reduction of the tendency to invest in fraudulent products, especially among the most risk-adverse individuals. So financial education seems to work well in helping consumers in dealing in finance. Charity did the same in Indonesia, and you find that financial literacy positively affects the ability to detect a scam. On the other side, we have a stream of the literature that analyzes the behavior on the relationship between financial literacy and financial behavior when we deal with credit cards. For example, Rob in 2011 found that an increase in financial literacy increased the likelihood to engage in more responsible credit card use. And Motola investigated the role of financial literacy on the gender gap when we deal with credit cards. But if we have to locate this study, we would say that this is a cross area between the financial fraud studies that has been mainly referred to investment frauds, and the credit card and financial literacy study that didn't investigate yet the case of financial fraud. So that's the location of this study. The study is based on a sample of college students, so 387 senior students from a faculty of economics in a university in central Italy, and it's based on a quasi-experimental approach. So what we have is a pre-test where the entire sample has been exposed to a questionnaire, has been invited to fill a questionnaire with information about their social demographic variable, financial behavior, and financial literacy and fraud literacy. So a stream of questions investigated how much they are able to identify a financial fraud or not. Half of the sample that has been identified randomly has been exposed to a seminar, and after the seminar, both the half of the sample has been invited to fill another questionnaire with financial literacy and financial and fraud literacy question. Everything has been done a few months ago, so in October 2019, and the aim is to see, as we did, how much financial literacy matter when we deal with investment, with payment card fraud. Why college students? College students is always a challenging sample, but the reason why college students has been selected is because I would like to investigate how a sample that should be more prepared than other in dealing with financial fraud is able or not to do well. There are three main reasons why this sample is should be more prepared than other in dealing with the fraud. Is the fact that they are attending university, and we had studies that prove how just the attendance of college tend to improve the output in financial studies, the behavior to improve the quality of their financial behavior. They are from a faculty of economics, so they should be even more interested in economics and finance than others. And they are seniors, so they should be exposed to courses like Introduction to Economics, Introduction to Finance, that somehow should make them be more ready to understand the function of a financial product, or just simply more ready to understand the function of the financial markets itself. We have two research questions. The first one is, does financial literacy help individuals to identify and avoid financial fraud related to the use of payment cards? The second one is about financial education, because does one-shot financial education seminar increase the ability of individuals to identify and avoid a financial scam? Just a look to the characteristic of the sample. They are pretty young because they are, of course, college students. Most of them are male, but not in a quite disproportionate manner. Most of them are full-time students, but we have a good representation of other categories like part-time, full-time worker, or freelance that are doing, they are attending college, and at the same time they are working. We investigated the education of parents because it could happen that their ability to do in finance is affected even by the ability of their parents to do well in finance. and education is a proxy of can be a proxy of their financial literacy. If somebody is still living with the parents or not can be relevant, because once you leave the nest, then you need to live by yourself. You must manage your resources, your financial resources by yourself, and this can be a source of learning and even a source of learning about financial frauds. If you're a foreigner, it's the same, and to be foreigner can be even tricky in a different manner, because you have to deal with the financial system that can work differently from the one of your own country, and this can somehow affect your ability to deal with the financial fraud. Your GPA is something that can be useful to consider, to include in the analysis, and the fact that you have been a victim or not in the past is something that can make you be more ready or somehow more aware about the risk of a fraud victimization. Then we analyze the ownership of payment tools. So more credit card, more debit card you have, more you are at risk, because simply if you do not have any card, you cannot be victim of any fraud on card. And we investigate even for different payment services like PayPal or SatisPay, or more international famous payment option like Apple Pay or Google Pay. Then we have financial literacy by the Luzardi Mitchell, and we can see that 3.57 is the average score, and is a bit higher than the average when we compare this result with previous studies. We have even 5 items only on the use of cards, and in that case we can see that the result is pretty lower, because only 1.41 correct answer on 5 is the average of that sample. A variable measures the self-assessment of financial literacy, so how much people tend to be confident about their abilities, and we have a mean of 4.34, and from the data we can see like a pretty clear normal distribution. Then we have the financial literacy fraud. This is an example, one of the 20 items we use to assess the ability to detect a fraud or not. This is just an example. You receive an email about an unauthorized uptime to your credit card that has been locked to prevent further issues. In the same email, you find a link to a web page where you can unlock your card by filling in the following information: first name, last name, credit card number, expiration date, and security code. So all the information that a scammer, that a fraudster need to use your card. The possible option you have to answer are these ones. So you can say that there is a risk of fraud. You can say that it's okay, no risk of fraud. Or you can simply say that you don't know. So you are unsure about the situation that looks suspicious, but you are not pretty sure about what's going on. With 20 items, you can have different streams of answer. Sometimes you can provide a wrong answer, and the wrong answer is the one, for example, when there is a fraud, but you say that it's okay. It's a correct answer if there is a fraud and you're able to say that yes, that's a fraud. And the wrong answer is the one when you say that that's a fraud, but it's not. So even when you overweight the risk of fraud in your personal experience. Then you have the case where you don't know. So in that case, you're not sure what's going on. And we can summarize those 20 answers in different manner. The first one is a score that counts the number of right answers, so the number of times that you did well. And we dichotomize everything in a dummy variable that is equal to 1 for the one with a high risk of victimization. So lower is your score, higher is your risk of victimization. But the variable will be equal to 1 if you are at risk. The second score tends somehow to refine this measure, the first measure, by accounting even for penalties anytime you fail an answer. So it's not only the number of times you did well, but account even for the number of times you did not well. You provide the wrong answer. In that case, the score works the same manner. So 1 is equal to the scenario where you have a high risk of victimization. Then a third score is the number of do not know. So the number of times that you say, I don't know if it's a scam or not. And this is something that works like a confidence index. So will be equal to 1 for the less confident respondent. It means that more you choose the do not know option, more you are considered like a low confidence individual. Everything was treated in a logistic regression because we have 3 dummy variables, and the control variables were the socio-demographic characteristics. So if you are a full-time student or not, if you live with parents, and so on. The availability of payment tools to check if the fact that more you are engaged with the payment system, more you can be at risk of fraud or not. The financial literacy using the 3 measures, so the Luzardo-Mitchell, the CARD score, and the self-assessment measure, and the risk of and the past experience with fraud in finance, so with financial frauds. What about results? Results say that in the 3 cases, I will just focus on the lower part that is about the financial literacy, so the key research question of the study. When we assess the fraud literacy by the first score, we find a positive effect on financial literacy on the ability to identify the fraud. We are dealing with odds, so any number below 1 is something that decreases the chance to have 1 in your dependent variable. So it means that we are something around 20 to 30% less likely to be victim, to be considered like at a high risk of victimization when you are able to provide correct answer to Luzardo-Mitchell question or the credit card literacy measure. This effect is not anymore so clear when we switch to the second score. That is the one that accounts even for the mistakes in your answer. So in that case, financial literacy is not statistically significant and so the hypothesis that financial literacy help you to be more ready in dealing with financial fraud is not supported. And the third score is the one that deals with the number of do not know, so it's the confidence index. Show how more you know, so higher is your score, less is the chance to not be ready. So lower is the number of times that you say do not know. So somehow financial literacy improve your confidence at least in dealing with your credit card. But in that case, self-assessment is something that matters. So this self-assessment of financial literacy and the knowledge on credit card, but not even the Luzardo-Mitchell is a statistical significant variable. What about the second research question? What about financial education? In that case, we use a difference in difference approach where we assess the gap between the 2 simple, the one that has been exposed to financial education and the one that did not. Difference in terms of their score. So the number of right answer, the sum of points that account for even for the mistakes, and the number of do not know answer. So we try to assess what is called the intervention effect. Results say that when we deal with the first score, we don't have a statistical significance result. So from a 0 to 20 score, the average was almost the same before the treatment, so before the financial education seminar, and is a bit higher for the treated group. So who attend the seminar tend to be more prepared, but that gap is not statistically significant. So we cannot support the hypothesis that the difference in score is due to the financial education. Similar results is for the second variable. In that case, the no statistical significance and the almost pretty close to zero difference between the treatment group and the control group deny the chance to say that financial education is playing a leading role in that story. In that case, we have just a small results for the number of do not knows, and what came out is that in the post seminar analysis, there is a statistically significant difference between the control group and the treatment group, and the treatment group tend to use the do not know option less than the first one. So we have somehow an evidence of an overconfident of a confidence provided by the financial education. So attending a course, attending a seminar, improve your confidence in dealing with financial fraud. So general conclusion. Point number one, we can see that financial literacy helped to identify financial fraud, but only one in the two cases, the variable is statistically significant. So the objective measure like Luzardo Mitchell and credit card literacy or card literacy are relevant to explain your ability to identify the fraud, but we need further investigation because it's significant only one in two cases. Second point, say that financial literacy helped to reduce the number of do not know answers. So we have evidence that increase your ability, your confidence. But if we match the two results, we could say that there is a risk of overconfidence, because a financial education seminar increase your confidence, but doesn't increase as much your ability. So the risk is that you feel more prepared, even if you are not so more prepared than others. Conclusion number three, say that even if we are dealing with somehow top-level participants that are supposed to be more prepared than others, only half of the respondents risk to be victimized in around 50% of the cases. So even those sample that is supposed to be better than other in dealing with frauds is not performing pretty well. So the risk of victimization is pretty high even in that case. The last point about financial education, we say that the single standalone seminar doesn't work, because the only effect we have is an effect on confidence, but we do not find a clear evidence on knowledge. In that case, additional analysis can be useful to figure out why we do not have this effect. It could be something related with the topic of the seminar, the length of the seminar, or the fact that we are starting from a level of financial literacy that is above the average, so the marginal increase cannot be so high to find a statistically significant result. So we have some results that are somehow interesting, but probably there is room for additional studies in that area. That's it. Thank you for your attention, and those are my contacts. If you are interested, or if you want to share some comments, I will be pretty happy to receive by mail. Thanks.
Thank you, Professor Nicolini, for your meaningful research about the level of financial education and literacy and the avoidance of financial fraud. I think your research has particularly important implications on how policymakers try to make education programs that are intended to prevent financial fraud. So, for example, in Korea, we have a lot of financial fraud called voice phishing or smishing. So the financial authorities, they have devised several education programs that are intended to educate the people to avoid these types of scams. But I think Professor Nicolini's research suggests that we might have to rethink that types of programs. So our third paper presenter is Professor Martin See of Kansas State University. Professor C will present a speech about financial literacy, financial well-being, and debt decision regarding mortgage lending. So Professor C, it is a pleasure to have you with us. The floor is yours.
Good afternoon. I really appreciate the invitation to speak. I'm sorry that I'm not joining you there live in person, but I do hope that if there are questions or thoughts that are spurred by this presentation, that you would be willing to reach out and share them with me. My name is Martin C. I am a department chair and associate professor of personal financial planning at Kansas State University, so about as far away from you as it can possibly be at this time. Today I'm going to share a little bit with you around my research agenda and how it has been informing the relationship between financial literacy, financial well-being, and mortgage decisions. Originally, I had been planning on trying to talk a little bit broader about my other research into debt decisions, but given 20 to 25 minutes, it seemed smarter to narrow this down, and I'm going to focus specifically on 3 studies that I've done that may help to shape this understanding. I am going to focus on my own research a little bit for this, but I know there's been lots of really good work that's been done out there. It's well cited in my work to understand this, but for the purpose of this narrative, I'm going to focus mostly on that work. So before I get into the work itself, I think it's really important at a higher level to get on the same page in terms of conceptualizing financial literacy, as this is really the core of the work that we're doing here. And despite a clear call from Houston in 2010, and I sort of heard seminal article on measuring financial literacy, the term financial literacy is still inconsistently defined and inconsistently measured. So a lot of this measurement differences has to do with what's available in the secondary data sets. And so I understand that a little bit more, where what's more troubling to me as I review the literature is inconsistent definitions and uses of terms. And specifically, the term financial knowledge and financial literacy are often used interchangeably. And I know you're here for this conference on financial literacy, but I really just wanted to bring that up as the importance of really differentiating these and using them consistently. Of course, I'm only bringing this to you because I face frustrations as a reviewer, reading articles, as a reviewer providing feedback, and authors that didn't want to treat these items as different. And I think we really have to take a stand and call a spade a spade. It's not a problem if we're just looking at knowledge. It's not a problem if we're looking at broader literacy. We just need to be really clear and consistent to better inform the literature. I am firmly a believer in the Houston model. I believe that financial literacy is a measure of human capital. As a measure of human capital, it's informed by 2 components. The first component of which is the knowledge dimension, and that is the stock of knowledge acquired through education and or experience related to an essential personal financial concept and product. I would highlight here specifically related to an essential personal financial concept and products. And that's one of the things that I think we're going to have to debate with as a research body, as many times we have looked at certain measures, let's say, for example, the Big 3 or the Big 5 from Lusardi and Mitchell, that have been broad measures of financial literacy, trying to get at some sort of underlying construct. And I often think back to the theory of planned behavior, where the theory itself indicates that we need to understand a context around the specific behavior. It's not just general attitudes, it's not just general norms, it's not just general perceived behavioral control, but it's those things as related to the specific behavior that we're investigating. I think in the financial knowledge domain, that we can have a better conversation about what are we truly trying to measure with knowledge, and what are the pros and cons of a broad measure or a specific measure if we're really trying to understand a specific behavior. The second component of that, of which is the application dimension, which is a combination of both ability and confidence. And that is knowledge alone is not enough. You have to have the ability and confidence to apply these components. if you look at Dr. Houston's broader construct, what you end up with is also layers of human capital that are built in, whether it's numeracy, things like that would also help to inform human capital, potentially inform the application dimension and get us to the full construct of financial literacy. Related to measurement, I just wanted to speak about this really quickly. I really have not seen the great measures of financial literacy that I feel great about. Generally speaking, there are inconsistent measures of financial literacy for both the knowledge and ability components. There have been a couple of attempts to create joint measures, but generally speaking, most research will use the knowledge component as one thing and the ability component as another, if they use the ability component at all. There are quite a few research studies that just want to focus on the knowledge component. The big three and big five are the most well used and cited from Lusardi and Mitchell. And that is well earned, and also they reign prominent because they're the ones that are in the various different data sets. But I've consistently used these measures, and I've had significant problems with reliability. They generally demonstrate very low reliability, which could indicate limited validity. Now, I know it's sacrosanct a little bit to talk negatively about those measures because they do provide so much more than we've ever had. But one of the things that I hope we can talk about is, are we better using these, or to be better with behavior-specific knowledge questions, or just focusing on the knowledge related to the behavior that we are investigating. I understand that we want and need a holistic measure of financial knowledge, of financial literacy. But just because we need that doesn't mean that we need to use something that may be suboptimal, at least based off of my experience in various different situations and data sets, looking at the reliability of using those as a scale. So related to financial ability, it's really been all over the place, and inconsistent use there. I think there is room for improvement. So that's enough of my diatribe overall on financial literacy, and I would focus a little bit more on mortgages themselves. And I labeled this tied mortgages and under-investigated debt because there are very few researchers that are currently investigating housing debt and mortgage choice among Americans. And the reason I think this is so important is that Americans' largest assets are their homes, which makes mortgages their largest debt. And generally speaking, mortgages are generally considered a method of consumption smoothing. Effectively, mortgages are allowing individuals to take future income and apply that to current consumption through the use of debt. They let them buy the house before they have the money. One of the things that I think is underappreciated about mortgages is that although housing is generally considered to be a conservative investment, mortgages create a highly leveraged asset. Say that again, mortgages create a highly leveraged asset. If you've taught a financial literacy or a financial investments class, you talked about buying stock on margin, and there are a number of individuals that can relate mortgages at some level to buying stocks on margin, and I'll show you a little bit of an example here. So take the average $200,000 house purchased with 20% down. This is a fairly common occurrence in the US these days. It's probably an average or slightly above average home price in many parts of the country. So this would be a normal scenario for somebody that's buying a house. So you put 20% down, and then you take a loan for 80%, which would be $160,000. So in this scenario, a 1% increase in home value, which is tied to the $200,000, is equivalent to a 5% return or loss, depending on which way the 1% went on investment. Because that return on investment is tied back to that 40%, that the $40,000 that is down. So 5 times, given a loan to value ratio of 80%. Well, like many Americans, my first home, I purchased it with 5% down in 2012. By the way, in 2012, this was after the mortgage reforms that were supposed to get rid of this kind of highly leveraged asset. They still exist, exist quite regularly in the US. These did not go away. For me, when I first bought my house, because of this 5% down, a 1% increase or decrease in home value is equivalent to a 20% return or loss on an investment if I bought a $200,000 house. I actually bought a $230,000 house, so I had quite the risk in those early years. The other reason why this is more important than ever is Americans are moving more often. They're changing homes more often. They're refinancing more often. Whereas it used to be a slow cycle, you lived in the same house over time, which sort of brought down that risk profile. And you had individuals that paid off their mortgages. That's no longer the case in the US. You have a lot more home churnings. The average tenure in a house is somewhere between 5 and 8 years, as opposed to buying a house and living there your entire life. So what this has done is kept more Americans in highly leveraged situations for longer periods of time, and with that shorter time band to selling it, that has created significant additional risk. So, given the large role that housing equity and mortgage play in American life, 2 questions here. Do financially literate households make better mortgage decisions? And 2, what is the impact of those mortgage decisions on well-being? So we're going to talk about this, and I'll telegraph the end. At the end of the day, this is all a cash flow story. We're talking about mortgages, but what we're really talking about is a cash flow story. So one of the first studies that I think I did in this area was around mortgage choice. And if you think back to the 2000s in the U.S. was a booming real estate market. We saw massive growth in the market over the first 6-7 years of that decade. And due to this growth, we saw a lot of innovations in the types of mortgages that were being offered. Whereas historically, the majority of mortgages were conventional 30-year mortgages. You buy a house, you make the same payment for 30 years. At the end of it, it's paid off. You saw massive growth of interest-only mortgages. And when I say massive growth, it grew from 6% of mortgages that were originated in 2002 to 31% of mortgages originated in 2005. This went from a specialty to a mainstream mortgage option. So as compared to conventional options, interest-only mortgages have several key characteristics. The first of which is they have lower monthly payments because those monthly payments are interest-only and there is no principal component. These mortgages, which were typically 5 to 7 years in length, had a balloon payment due at the term of the loan. What that means is when the loan was up, you owe the full balance of the loan, and that balance, of course, is the original balance that you borrowed. What this means is these are complex and highly risky loans. In best case scenarios, these were often a bridge to a conventional option. So for example, you would take an interest-only loan, and when the balloon payment became due, you would refinance typically over to a conventional loan, and you're hoping at that time, of course, the home value has gone up. Considerable problem if the home value goes down, which we'll talk about in just a minute. The other area where you often saw these that were quite rational is for individuals that were trying to flip homes, that were trying to own it for a period of time, repair it, take advantage of some appreciation, and then selling it. But once again, if we're at 31% of mortgages that were interest only, we are not in those specialty cases. We're not in those specialty cases for the majority of these. So as we know, what happened at the end of the 2000s is there was a real estate crash, and what that did is caused home values to plummet. For conventional mortgage owners, this was bad, but they were able to continue status quo. They could keep making their payments. They had another 30 years, and as you know, the value of the home at any given point in time really isn't a big deal unless you have to sell it, or in this case, if you have to refinance your loan, because interest-only mortgage holders were left with balloon payments that exceeded their home values. So what this means is that what ended up occurring is that interest-only mortgage holders defaulted on their mortgages or simply walked away from their debt altogether at exceedingly high rates compared to other mortgage types. So while obviously this is a little bit ex post facto, the question is, were interest-only borrowers making rational decisions? Were they informed? Did they understand their mortgage choice? For those that chose the interest-only loan, did they understand and were they able to evaluate that scenario? So using data from the 2009 NFCS, we did a study that investigated household mortgage choice. Specifically, we were looking at interest-only versus fixed rate versus adjustable rate mortgages. All of these have different levels of risks, especially around interest rates for adjustable rate mortgages. But interest only is by far the most exotic of these mortgage choices, with no interest at all being paid. And what we found, and this data from 2009, we were able to look at basically home purchases that were taking place in the first half of the 2000s. I think we went back to 99. And what we found is that consistent results indicated that financial knowledge, that is understanding of interest rates, understanding of mortgages, understanding of diversification, were negatively associated with the use of interest-only mortgages as compared to conventional options. That is, financially knowledgeable people were less likely to use interest-only mortgages. Conversely, those that did not understand those financial concepts were more likely to use interest-only mortgages, holding all else equal. Meanwhile, respondents with higher reported math skills, which in this case was our measure of financial capability, financial ability, they were less likely to use interest-only mortgages. So in short, what this study did is provided some evidence, and there are other studies that have buttressed this, that financially illiterate households were more likely to use a complex product that left them exceedingly vulnerable to market fluctuations. Exceedingly vulnerable to market fluctuations. The other thing that this did, as well as the surrounding literature, is it suggests that financially illiterate households put significant weight on cash flow considerations. I'm going to share a little bit more with that. The big thing that determines how much house you can buy is what your monthly borrowing amount is. One of the things that was common during this time was for you to try to set up your mortgage in a way, especially in appreciating home values, so that you could buy the most house possible. Interest-only mortgages were the best way to do this because with there being no principal component, your monthly payment would be significantly lower, which makes your borrowing amount significantly higher. So what this research seemed to indicate is that, one, financially illiterate households were not able to fully understand and evaluate interest-only mortgages, and there may have been an over-reliance. They may have been sucked in by that low payment amount. So with this study, we sort of found that financially illiterate households are making suboptimal mortgage decisions. But my next question is what are illiterate households doing with mortgages? So they avoided doing this, but are they doing ways to take advantages of mortgages? So there's a body of literature out there, and Smith, Finca, and Houston were one of the first to go along this line that indicated that holding mortgage debt may be a rational choice. That is, it may be rational to seek or maintain mortgage debt. And a lot of this was framed around the interest rate market that has been prevalent in the U.S. for quite a while now, with historically low or relatively historically low interest rates on mortgages. And what this allows you to do, and especially with a fixed rate mortgage, for example, I have a 15-year mortgage at 2.65% right now on my house in Manhattan, Kansas. It allows me to have a fixed borrowing cost. That allows me to, keeping that mortgage and maintaining that mortgage, and allows me to place assets in other places. For example, I'm able to put more money in my retirement account with a time horizon of 30 years, that with the average stock market return over that time period being around a 7% return. So I'm paying a guaranteed carrying cost of 2.65%. that, by the way, at least until recently, had tax deductibility. That went away with Trump tax reforms. I am able to basically have a 265 carrying cost. It used to be smaller than that, so that I can keep money and invest money in a longer term asset growing thing in the stock market. And so in 2016, Smith and I put together a paper that actually showed this trade-off and how it can make sense to follow through with this. And we did provide some preliminary evidence that sophisticated households were, in fact, making a rational decision here. Now, the next thing that we did on this, though, is we tried to understand how households were acting around this mortgage choice, about having a mortgage and about actively maintaining higher loan balances. And so KT Kim out of Alabama and I and Hiram Smith did this using the 2010 and 2013 Survey of Consumer Finances. And in this, we investigated the relationship between literacy and mortgage decisions among middle-aged households. So these are the prime mortgage holding individuals. And what we found here is that during this time of record low interest rates, financial sophistication was positively associated both with having a mortgage, holding all else equal, and among those that had a mortgage, higher loan to value ratios. One of the things we did in this is we applied the Heckman two-stage correction to deal with selection bias that could occur if we just looked at loan to value ratios alone. And this result did carry through in both scenarios. And what this suggests is that financially literate households may be using leverage to increase asset return. So our first example of research basically found that financially illiterate folks were making suboptimal decisions, and on the upper end related to debt, that there may be efficient use of debt for these financially literate households. So from there, I tried to connect mortgage debt with well-being. Because at the end of the day, I think the end goal is utility, and it's maximizing well-being. So what role do mortgages play in informing financial well-being? And there's a body of literature out there that says you can't just look at the financial cost or financial benefits of any specific recommendation. You also have to look at the psychological costs that might be incurred by taking a financial act. For example, that's why you typically would recommend using the snowball method in paying off credit cards. While rationally, you want to go ahead and have individuals pay off the highest interest rate, the psychological win is far more important than the dollars saved by having them pay off the one that they can pay off to completion quicker. In this case, related to mortgages, even though it may be financially rational to hold a mortgage, is there a psychological cost to holding this debt? And Brown, Taylor, and Price did sort of the first research, really good research on this in 2005, and they found that basically different debt types can be viewed differently. And I think we provided some insight into this, but basically financial literacy and mortgage debt influence well-being. So we did a study in 2015 where we sought to understand financial satisfaction among retired folks in the U.S. And we did this using data from the 2012 NFCS. And we sought to both connect the literacy and the debt component onto financial satisfaction. Effectively, we tried to apply the behavioral life cycle hypothesis, which would indicate that literacy and mortgage debt shouldn't matter. Money should be non-fungible. But after you consider that, understanding if money should be fungible in the life cycle approach. After considering that, would mortgage debt reveal a bias? And what we found is that after controlling for financial literacy and an individual's comfort level with debt, there's no significant impact of holding a mortgage on financial sophistication. Okay, so generally speaking, and what we also did find, and many of you may have known this if you've looked at this yourself, financial knowledge is usually negatively associated with financial satisfaction. Those that know more are less satisfied, and oftentimes financial confidence is positively related. So those that know more are less satisfied. Those that think they know more are often more satisfied. But one of the things that is really critical in this, that's related back to the other research that we found, is that if you look at the magnitude of relationships, significant evidence indicated the importance of financial fundamentals. So while literacy was significant and mortgage debt was insignificant, really the driver of satisfaction levels, and this has been true in pretty much every financial satisfaction study you've seen, has been the presence of an emergency fund and difficulty paying bills. In other words, for those with cash flow constraints, financial satisfaction was significantly limited. Those that didn't feel that were able to make higher level decisions. So when you synthesize these together, what you see is divergent use of mortgage debt between the financially literate and the financially illiterate. While the financially literate households appear to be using debt in ways to increase well-being, increase long-term net worth, financially illiterate households appear to struggle to evaluate the implications of new products and may be overly reliant on the impact on short-term cash flows in terms of their evaluations. So basically, the wealth gap is being reinforced through the lack of financial literacy. So, as I take this to sort of a wrap up, I think what I would share is this is really a cash flow story. In the presence of cash flow constraints, financial literacy is critical in enabling consumers to make rational decisions. In scenarios like this, borrowers must be equipped with the knowledge, ability, and self-control to make the right long-term decisions and to withhold the pressures of those cash flow constraints. My last point off of this is really a hypothetical. Maybe it's a little bit sarcastic, but why the heck aren't more people investigating mortgage decisions? These decisions are so impactful on the lives of consumers and borrowers. And we need more people out there who are investigating these mortgage decisions and how these mortgage decisions are really changing individuals' life trajectories. And I can't underemphasize that we would not, in most low to middle income households, are not buying stock on margin. It's viewed as too risky, and there's significant regulations and limitations around it. But we allow massive and encourage massive through our public policy, massive use of leverage on housing debt, as the cultural norms continue to change away from living in your house your entire life. So with that is a summary of sort of the narrative that I wanted to share about the relationship between financial literacy, well-being, and mortgage debt. I know there's so much good research going on out there. I hope this might have been helpful in sharing a little bit of my story and narrative on that. I wish I was there to listen to everybody else, but I thank you so much for the opportunity to speak with you today.